the share market is now looking towards 2 years of quite subdued profit growth as a result of a very strong move upwards in interest rates and in bond yields that is still ongoing. And so as a result of that, it always will become more of a struggle for the share market, because at the end of the day, financial markets, in particular equity markets, it's all about corporate profits and not just about dividends. Now, on a macro level, one of the changes that is taking place is that because we in phase one, it's all about bond yields and interest rates, and not so much yet about that deceleration in corporate profits. It's that a lot of movements are macro inspired. I mean, it's a sector is in, the sector is out, another sector is in, another sector is out. What we are moving towards now is more of an individual company focus, and that is because even the August reporting season already showed us that within a sector we can have very different performances from companies in between, and that is now going to be more and more the focus of the market. So while we are still going through the tail end of the macro-driven movements in markets, and this week and September are very good examples of that, increasingly the focus of the market will move towards individual companies and how they differ from other companies. And that is logical, because what will be on investors' mind increasingly now is which company is good enough to withstand this downward pressure. And in very simplistic terms, how does your company perform when there's a recession coming? Now, one of my favorite scenes in Hollywood is that A Few Good Men, when Tom Cruise puts Jack Nicholson under pressure, and he finally, when the levee breaks, he goes like, "I can't tell you the truth because you can't handle the truth." And I can fully understand that the first opening slides of my presentation today, they weren't necessarily the most joyful, but I am counting on the fact that you can handle the truth tonight, and I'll just be promising that I'll be as brutally honest as possible, making sure that today's story is not necessarily by default all in negative, but you have understood probably it's not all in positive either. And one of my favorite observations for the share market is that worst case scenarios, they are sometimes priced in, but they very seldom materialize. I mean, you can argue that the period late 2007 to early 2009, that was actually quite an exception. I mean, other bear markets tend to be more gentle, if I can use that word. And as I said earlier, it's not necessarily baked in yet that we will see a repeat of a worst case scenario. Nevertheless, I do think that investors should be very mindful of the fact that this process is by no means finished yet. We might even be only halfway. And the fact that the Australian share market has outperformed markets in Europe and in the United States and in many of the emerging markets by no means means that I think we should be complacent as Australian investors. There are some particular reasons why, at face value, looked from the top down, that Australia has performed relatively well, but other markets definitely have not. And it's also the composition of those markets gives us partially an answer to this. So in other words, I think we should be mindful of here that ultimately, yes, ultimately history shows us that we will always come out of this, and we will always move towards the next uptrend that might last more than half a decade. But between now and then, it could get nasty here, and we should be mindful of that, if that hasn't been obvious just yet. If you look at history, whenever the bond market has to make a major adjustment, the last time it happened was in 1994. It's very simple. In 1994, every major asset suffered a loss for the year. And we're talking gold, we're talking real estate, we're talking stocks, and we're talking bonds, and we're talking most commodities. Is 2022 different? I don't think it is. And I think we will find that most assets over the year will have a negative return. Question number one, are you still convinced that cash is trash? I've been advocating to people, this is probably a good year to have an above average level of cash in the portfolio. Number one reason, it doesn't fall by double digits overnight, as other assets can do. And the second reason, of course, is that when opportunities open up, and bear markets do open up opportunities, you want to have the cash available. The open question that I won't be able to answer today, and that will have an impact, and we will have to find out how that works, is that apart from raising interest rates, the Federal Reserve and other central bankers are also going to run down their balance sheets. It's called quantitative tightening instead of quantitative easing. Now, if quantitative easing has helped US equities to outperform the rest of the world over the decade prior to this year, then it's probably also good to assume that quantitative tightening will now become an automatic headwind for US equities. And how exactly that's going to pan out, we don't know, but it may well be that we might be looking at Australian equities outperforming the US for longer, because we don't have an equally aggressive central bank here, and quantitative tightening here will never be the same headwind as it is over there. Now, I can make all kinds of forecasts and projections, and then you can believe me or not, but partially of what I do at FNRIN is I actually pay attention to all the forecasts that the experts make. And I've chosen for today's presentation, I've chosen the one expert that is quite highly regarded in Australia. He's the chief economist of Westpac, Bill Evans. And you can see here, this update was published only last week. And you can see Bill Evans' forecast for 2023. That's literally taken from the report. It says sharp slowdown. We should know what that means. There's a hot debate going on whether we are moving to a global recession and which economies exactly will have a negative growth at some point. I actually think that's not that important for us as investors. The fact that Australia is going to escape a recession is not that important. What is important, I think, is that we are moving from a period when we had quite solid growth as an economy, and it will be a lot less from here onwards, and that will have consequences. That will have consequences for the local employment. It will have consequences for the housing sector. It will have consequences for household spending, for business spending, and it will have consequences for, obviously, for government receipts as well. If I stay with Westpac, I've now put together their forecast for the 4 regions that are probably of most importance for us as Australian investors. We have Australia, the Eurozone, the USA, and China. Now, you can clearly see here, just from economic growth, that we all came out of the 2020 period, which was negative. China was still positive, but the number was so much lower than what they normally grow at, that we have a couple of good years coming out of that because we are in the recovery phase. But for next year, the numbers are really, really low. I mean, Australia still is there with 1%, and that if you wiggle a little bit, you take some wiggle room there, then it's feasible that we might have a negative quarter here or there. But most people think over the whole year we will stay in the positive, although the growth will be, as a whole, will be a lot lower than what we saw over the past 2 years. For the Eurozone and for the USA, however, you can see that Westpac has only penciled in 0.5% growth for the whole year, which means nothing really has to go wrong a lot to make that a negative number. And the other observation, of course, to make is that if it's 0.5 for the whole year, that almost by definition means you will have 1, 2, maybe even 3 quarters of negative growth, and then 1 positive, and that's sort of like the average of that becomes 1 positive. So not fantastic, and this somehow will have consequences for businesses, of course. The one exception here, which some of you might have already noticed, is that if everything goes to plan, China will have its trough this year, and they will have quite a sharp recovery next year. Two asterisks to that forecast. One is the reason why Chinese growth this year is so low is because they keep fighting COVID with very blunt measures. They actually close down whole cities. So the recovery of next year is then, of course, is then premised on the fact that they stop doing that at some point, and they do get COVID under control. The other point, of course, is that the housing market in China is really, really weak this year. There's a lot of structural problems in there. Asterisk number two, on the premise that they fix that sort of, they might have a better year ahead next year. One important observation to make here is that when we came out of the GFC in 2008, 2009, China took the lead and realized what needed to happen at the time and invested so much that it literally pulled the rest of the world out of the quagmire. There's literally no one around who still thinks that China will do the same this time around. They're not in the same position, and then don't have that same inclination either this time around. Just a very small remark on the sentence that's on top of the page. I'm sure that a couple of guys that are watching today, if you like numbers, you like that kind of stuff. Historically, when global growth falls below 3% GDP, that's usually when bad things happen. Companies get into trouble and all of that, and countries get into trouble. On current forecast, we will be there next year. So stay tuned. This year, we've had already a handful of countries getting into trouble. So far, they are countries that do not necessarily have our direct attention. They do not make the front pages of the newspaper, for example. But needless to say, that might actually change at some point throughout this process. Now, coming back to the August reporting season, and the August reporting season was interesting on many levels, but the big intro I just gave you, that was obviously the context in which the August reporting season took place, and analysts in general were very worried already about what would be the impact on corporate Australia. As it turned out, corporate Australia did actually relatively well, at least for the numbers up until now. And the obvious observation to make for my part is that while we all had challenges ranging from rising costs, for not finding staff, from bad weather, rising interest rates, and so on, the one element that most companies, most segments in Australia yet didn't have to deal with is a declining trend in demand for their products. And because that is missing so far, and logic tells us that is yet to come, the market has become very skeptical about various segments about the Australian share market. And the most obvious ones are the discretionary retailers. They have very few friends at this point in the cycle. And we will have to see whether those beaten down, cheap-looking share prices, whether they actually are excellent value. They probably are on a longer-term horizon, but we yet have to find out whether they also are excellent value on the 12-month horizon. Now, a few conclusions from the August reporting season. The energy sector is globally and in Australia is the #1 performing sector. Every fund manager has a big chunk of allocation to the sector. But that's on the assumption that energy can't fall. We have a crisis in Europe. We have the situation in the Ukraine. We have OPEC trying to control the sector, and we have too high costs in the US to make a big dent in supply at this point in time. Historically, and it's always my favorite observation, historically, investors in a knee-jerk response, they stash up on resources and on energy and on cyclicals as a protection measure against inflation. And historically, it always shows it only lasts for a particular point in time. Usually, when you move into a recession, those sectors are very flawed safe havens, so to speak. And I'm still inclined to think that this time will not be different. Not every commodity producer this year has performed, and that's probably a big understatement. One of the things we learned in reporting season is that a lot of the smaller producers, they cannot control their costs. And for example, the gold producer, local gold sector has been the big disappointment for investors this year. Two things. I'll talk about gold a little bit later as well, but probably the prime thing to remember here is that investing often happens on very broad measurements and narratives, and people don't pay much attention to details. It was always clear to me that gold would not perform in 2020 because of the interaction between the US treasuries and gold. And gold can only perform as a hedge against inflation if the US Treasury market allows it to. Historically, gold is a very flawed safe haven for inflation. It works very well when inflation is very high, but we are at the moment looking towards a situation where just about everyone still thinks that inflation, while it's high now, it will come down, and it might take 2 years, but we will see it back around 2.5%, 2%. That's not a very promising dynamic for gold. Equally important, August, if not August, then definitely 2022 is probably the peak in dividends. We have had an enormous growth in dividends over the past 2 years. The irony is that, yes, we saw a revival in bank dividends, but the big push comes from the commodity space. We saw this week as well when New Hope Corp released their numbers. They are absolutely swimming in cash. Can't believe the context in which they operate these days. That goes for every gold producer at the moment. The same has happened for energy stocks. The same has happened for iron ore stocks. And we should always keep in mind that they are very cyclical, and the conditions under which they have been operating over the past 2 years have been nothing less but exceptional. Having said so, there is a narrative that some of the commodities, you can almost call them captive commodities, in that they've basically, their customers can't go without them, and there is not enough supply available. And that is, to a certain extent, probably true for some of the smaller commodities. I mean, think about uranium, think about maybe rare earths, and maybe even lithium. But I'm very skeptical whether that also goes for copper, aluminium, even crude oil. And we've seen that this year, I think. I think the price of crude oil is a lot lower than what investors would assure me early in the year, that it would never go that low. And we can probably see in prices of aluminium and copper as well that the world is preparing for a global recession next year. The problem with commodities is always that difference between short term and longer term. I mean, if I take copper as an example, I mean, just about every forecaster is predicting a substantial shortfall of copper supply by 2030. The problem is that in between, we have a global recession coming, and that global recession is more than likely to happen next year. As I say at the bottom, the downgrades are coming, and we yet have to find out how long, how low, and how exactly what the impact will be on Australian companies. My prime focus, if anyone would ask, has been definitely on can these companies withstand the downward pressure next year. Very simplistic. This is what we do with F&G Arena. We amalgamate the data, we pay attention. I'm not going to spend too much time on this, but this was February, and you see that in February we had 43% of the companies beating expectations and 20% missing. In August, you see those numbers have deteriorated. It's only 30 and 26 respectively. And if you go to the averages, you see the loss of momentum even without the downward pressure on the demand side. It wasn't necessarily a very bad season. It definitely was not, but it also wasn't a very fantastic season, and in particularly not if you put it in the context as it was. Looking forward, earlier I took Westpac as an example. I mean, Westpac is not the only forecaster, but I don't think as an investor we should get too bogged down in the exactness of forecasts, but it's more the broader trends that we should be paying attention to. In the same respect, I've taken Macquarie here for more of a segmented overview of the Australian share market. Again, at the bottom, you see that the numbers I gave you earlier for 23 and 24, which was around 6% and 3%, you see that Macquarie has already positioned itself lower. So they already are, you could say, leading the market, or they're definitely have lower expectations than their peers at this point in time. That the composition of that is quite interesting, because you see, for example, the banks. A lot of people own banks. A lot of people think of the banks as beneficiaries of the current environment. But if you look at the basic numbers, you see there is very little projected in terms of growth. That is also because the negatives of what is happening this year are believed to ultimately offset the short-term positives. Of course, always differences of view, and there is probably a fair amount to be said that those dividends are not necessarily to be cut unless things get really, really hairy. For some sectors like the REITs, for example, I mean, the numbers look okay at face value, but underneath the numbers, the polarization is enormous. And this is also a warning to most investors. Half of the REIT sector, I mean, and I might be generous here, they're basically carrying too much debt. And what is happening this year is that rising bond yields, higher interest rates, it means that they need to spend more money on servicing that debt. And that REITs already are usually not known for very high growth numbers. That means that half of the REIT sector will find it very, very difficult to have steady, sustainable growth in the years ahead. Hence the polarization. So at this point in the cycle, you would probably look at REITs, and not just REITs, but companies in general, that do not carry very, very high levels of debt, because it will eat, amongst other things, it will eat into their profitability. Now I've mentioned polarization. Let's have a look at what the resources sector, I mean, after a fantastic year that is just finished, and the year before was quite fantastic as well. There were 2 negative years on Macquarie's forecasts, and that is because Macquarie is convinced that we will have a global recession next year. But then you go and look at the small resources, and you see that there is a different number. And that I would wager is because we have that polarization into the likes of lithium and uranium, for example. And the top part, that would more represent the copper, the aluminium, and the iron ore. In very simplistic terms, Macquarie distinguishes between banks, REITs, resources, and then all the rest. So what they call industrials is everything outside of these 3. Remarkable here is that the international industrials, they keep on performing, and all else being equal, there should be plenty of growth there. And in Australia, we do have some of the very high quality international players, of course, but Macquarie also anticipates that we will see a sharp recovery in the domestic industrials as well. As per always, these are generalized numbers. I mean, you see, for example, that there's plenty of growth foreseen for small companies, but then the industrials are negative. So this is also why the individual company performance will become increasingly more and more important. I've mentioned commodities earlier. I know that a lot of investors love commodities. If you own them at the right time, the returns can be absolutely astronomical. In recent years, we've seen the commodity sector literally being reformed into massive payers of dividends and special dividends and share buybacks and all these extra benefits. At this point in time, forecasts are that what we are experiencing this year is the peak. It'll become less from here onwards. Now, how bad, how less, that's of course something we'll have to find out. But on current forecasts, there are a few things that I think are worth highlighting. Now, if I start with lithium, Elkem is the preeminent lithium producer on the Australian share market. If for the time being we don't pay attention to mineral resources, then the irony is, of course, that there's very strong growth is forecast, and shareholders might actually be looking forward to their first dividend in 2 years' time, which is completely against the trend that we saw earlier for the sector as a general. Now, for the sector as a general, you see that the dividends are suspected to fall because profits are falling for the likes of BHP. But because the market has never really believed that it was sustainable in the first place and is now looking forward to leaner times, the yields on offer on those share prices are still very, very high. I mean, this is well above investors under normal circumstances should expect from, in particular, such a large company like as BHP. Situation is not different for the coal producers. And in the current situation, after the merger between BHP Petroleum and Woodside Energy, that situation is also not different over there. I mean, if I had to own, and I'm not a big fan of energy stocks, but if I had to own an energy company, it would probably be Woodside. And you see also this year that Woodside has outperformed the sector and has outperformed the movements in the price for oil and in gas. Also because there's now a very strong company-specific dynamic going on, that their balance sheet is much better. The leverage on the balance sheet is extraordinarily low now for their measures. They are literally swimming in cash, and they have a lot of synergies which they can extract out of the merger of those businesses. Again, just to show you that there are always individual exceptions to the general picture. And the other thing, the obvious remark to make is that if you have the right stomach for risk and for volatility, that there's an argument to be made that if you get these high yields on the premise that they hold, then maybe you can own these shares in your portfolio, because they do provide, to a certain extent, a cushion against further share price weakness. Now, I talked about gold earlier. I don't want to make this an anti-gold narrative or anything, but I do believe that gold has been a victim this year of investors being too easily assuming that if we go through a period of high inflation, that gold would be the outperformer in the market, and it hasn't been. That's not the purpose of this chart here. Why are we revert back to gold? What I want to show on this chart here is the difference between owning bullion and owning gold producers. And the dark blue line here, that's an index that basically stands for international producers of gold. And the gold line, that is bullion. And what you see is that in times like in 2020, when gold is in fashion, you see that the producers actually trade at a premium, which is what I always say to investors. In accordance with your risk profile, you can make more money, more gains out of producers in the good times than you would by simply owning bullion. But when you get in a time like this year, when gold is not really fashionable and it's really struggling to perform, what you see is that your producers all then fall back to a discount, a relative discount, which in practice means your losses will be a lot larger by owning the producers. Now, don't automatically assume that a falling share price is better value, but you and I both know, historically, gold will become into fashion at some point, and those producers will trade back at a premium, of course. And as I explained earlier, in an environment where the real interest rate, the real yield on American bonds is projected to fall over the next 12 months, gold will desperately need another driver to perform. And if that's not coming from a war or from the recession itself, then gold will actually keep on struggling for longer, I believe. Now, in a general sense, and that's definitely a theme that also comes back to from all the expert strategies I come across. The knee-jerk response, and that there is a very good logic in there, is that when you're facing, as investors, when you're facing tougher times ahead, is to get rid of the rubbish in your portfolio and to reduce overall risk. And in company format, that means that you go for the quality companies. And what I mean by that is that you go for the companies that are very unlikely having to cut their dividends and have to issue a profit warning. And that's basically the long and the short of it. So more than the value of the shares, I would argue, you now have to look at the character of the quality of the companies. And of course, you add things like they generate enough cash flow, they have low debt, and management does its best, and they have a proven track record and all of that. Companies that immediately come to mind, nobody will be surprised if I mention the likes of ResMed, CSL, Car Sales, Woolworths, Steadfast. Those are companies that investors should be thinking of, irrespective of economic recession or not. Those companies should continue growing, should not have to issue a profit warning, and in most cases should still be able to increase their dividends. And with that view, I actually think we are coming towards the end. My analysis, my personal analysis, is based on seeking out those companies. I build a portfolio around it. I'm always open for questions if there's any interest. The other thing which I also do is on an irregular basis, I curate a report. I put some of my personal writings together, and they're supposed to give you a different perspective on investing and maybe stimulate your thinking. If you are interested, that report is very, very easily to access and to find. You go to fnr.com and then you put after the address /secret, and that should give you access to the secret report. Having said all that, I hope that you agree with me that this is not necessarily just a negative story. There's definitely a silver lining around this. And I'm open for questions now, and I hope you liked it, guys.